Environmental issues have become increasingly material to investment analysis because they can significantly influence the risk, return, valuation, and long-term sustainability of economic activities. Climate change, resource scarcity, pollution, biodiversity loss, water stress, and environmental regulation can affect cash flows, operating costs, asset values, and competitive positioning. Investors now recognize that environmental factors are not merely external concerns, but can create financially material risks and opportunities across industries and asset classes. Assessing these impacts enables investment professionals to identify vulnerabilities, evaluate resilience, and uncover opportunities linked to sustainability transitions. Consequently, environmental analysis has become an important component of modern ESG integration and investment decision-making processes. When evaluating potential investment opportunities, environmental factors can reveal both risks and sources of value creation. Companies that effectively manage environmental challenges may benefit from stronger operational efficiency, lower regulatory exposure, improved stakeholder relationships, and enhanced long-term competitiveness. Businesses involved in renewable energy, energy efficiency, pollution control, sustainable agriculture, water management, and circular economy solutions may experience growing demand as sustainability concerns increase. Conversely, companies heavily exposed to environmental liabilities, resource depletion, or carbon-intensive activities may face higher costs and declining profitability. Investors therefore assess environmental performance to identify opportunities associated with sustainability trends while avoiding investments that may be vulnerable to future environmental disruptions or regulatory changes. Environmental considerations also have significant implications for corporate finance. Companies increasingly face environmental risks that influence capital allocation decisions, financing costs, strategic planning, and enterprise valuation. Environmental liabilities, remediation expenses, climate-related disruptions, and regulatory compliance costs can affect earnings and cash flows. At the same time, strong environmental management may improve access to capital, reduce financing costs, and strengthen investor confidence. Corporate issuers are increasingly utilizing green bonds, sustainability-linked financing instruments, and other sustainable finance mechanisms to fund environmentally beneficial projects. Financial markets increasingly reward firms that demonstrate credible environmental strategies and effective management of sustainability-related risks, making environmental performance an important consideration in corporate financing decisions. Environmental issues are equally important in project finance, where long-term infrastructure, energy, transportation, and industrial projects often have substantial environmental impacts and dependencies. Lenders and investors evaluate environmental risks because project viability may be affected by regulatory requirements, climate-related disruptions, resource availability, environmental permitting processes, and stakeholder opposition. Projects involving renewable energy generation, sustainable infrastructure, water management, and resource efficiency may benefit from favorable policy support and growing investor demand. Conversely, projects with significant environmental impacts may face increased financing costs, delays, legal challenges, or reputational risks. Comprehensive environmental assessments therefore play a critical role in evaluating project feasibility, risk exposure, and long-term financial performance. Environmental factors also influence public finance initiatives as governments increasingly allocate resources toward addressing environmental challenges and supporting sustainable development objectives. Public investment programs often focus on climate adaptation, renewable energy deployment, resilient infrastructure, conservation efforts, pollution reduction, and environmental restoration projects. Governments may issue green bonds or establish sustainability-focused funding mechanisms to mobilize capital for environmental priorities. Environmental risks can also affect public finances directly through disaster recovery costs, infrastructure damage, healthcare expenditures, and reduced economic productivity associated with environmental degradation. Consequently, environmental considerations have become increasingly important in fiscal planning, public investment strategies, and sovereign risk assessments. Within asset management, environmental analysis supports portfolio construction, risk management, stewardship, and long-term investment performance evaluation. Asset managers assess environmental factors across equities, fixed income securities, alternative investments, and multi-asset portfolios to identify material risks and opportunities. Climate change, carbon exposure, resource efficiency, biodiversity impacts, and environmental governance practices are increasingly incorporated into investment research and portfolio optimization processes. Environmental considerations may influence asset allocation decisions, security selection, engagement priorities, and sustainability reporting. As environmental risks become more financially significant, asset managers increasingly view environmental analysis as an essential tool for enhancing portfolio resilience, supporting responsible investment objectives, and creating sustainable long-term value for clients and beneficiaries.